Making careful investments when you're young has the potential to make you extremely wealthy over the course of your career. Time is on your side, and not taking advantage of those early years is a wasted opportunity. How are you meant to know which investments to make when the topic might seem confusing and overwhelming? In this video, you'll see where you should put your money to get returns significantly greater than what you could earn in the stock market, as well as techniques to maximize your retirement savings. Keep an eye out since this video may be of interest to you. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. Making money that will assist you in reaching future investment goals is crucial. Investing in a career should be a priority for anyone who hasn't already done so. How are you going to invest in assets if you're earning minimum wage and have nothing left after paying your bills? Having something left over, even if it's not much, to begin investing in a career means finding something you enjoy at least enough to put effort into and something you'd be content doing every working day. This could be pursuing a career requiring higher education, starting your own business, or getting a job. Think about it carefully. If a large portion of your income is going towards student loans, car loans, and other miscellaneous debts, you will have nothing left to invest. Even more important is eliminating high-interest debt before investing of any kind. Paying down debt does not involve the same amount of risk as investing in the stock market. There's a chance of making money, but there's also a chance of losing money. If you pay off a debt with a 10% interest rate, you're guaranteed to save 10%. It doesn't make sense to take on investment risk for a 10% return if the interest rate on your debt is anywhere between 10% and 20%. Renowned hedge fund manager Peter Lynch believes that purchasing a home is one of the best investments you can make, which says a lot coming from a professional stock picker. Homeownership is a great investment from a traditional standpoint because you won't be paying your landlord's mortgage, but it can also provide an excellent return. Let's say you buy an average-priced home for $350,000 and put down 5% or $17,500. If the home appreciates 3% in the first year, that's a $10,500 increase, giving you a 60% return on your cash investment. Additionally, your mortgage principal is decreasing with each payment you make. Buying a home makes the most sense when the monthly costs are the same or lower than renting. Consider purchasing a property that can generate some type of rental income. First-time homeowners can also become real estate investors by purchasing a duplex or a triplex, for example, where the rental income could cover all of the expenses associated with the home, including the mortgage, and where only a small down payment is required. This is an excellent move for anyone willing to take on the responsibility of becoming a landlord because you will not only receive a fantastic return on your down payment, but your housing costs will also be covered. Perhaps the simplest way to become wealthy over time is to pay yourself first. It's worth repeating since if you don't do it, you're unlikely to invest at all. Every week, month, or whenever you get paid, set aside a percentage of your earnings for investing. Do this before paying bills. You may live a better lifestyle by buying nicer clothes, driving a better automobile, and taking more frequent vacations when you go shopping or out. However, that money saved will grow to incredible amounts over a couple of decades. A small amount of money set aside today could mean hundreds of thousands or millions of dollars by the time you reach retirement age. Investing 10% of your income is a good starting point, and you can increase this percentage as you get better. When it comes to earning and saving money, you have several high-quality options with the money that you pay yourself. If your employer matches your 401k contributions, this is an opportunity to get extra money that you otherwise wouldn't have. Matching contributions to a 401k is another guaranteed return on your investment. Roth IRAs are another option that you shouldn't overlook because the money you withdraw from a Roth account during retirement isn't subject to income tax. Contributing to a traditional IRA is a great way to reduce your taxable income. A taxable brokerage account offers more flexibility than a retirement account, but that flexibility means you'll be foregoing tax breaks. In one of these accounts, you must choose where the money is invested, so that it does not lie idle and lose value due to inflation. A widespread misconception is that the money you contribute is automatically invested. However, 401k and IRA accounts are just types of accounts, not investments. You would not want to invest in these accounts for 30 years, only to discover that it was never invested and is now almost worthless. With a 401k, it is up to you to decide where the money in the account is invested. Your company will provide you with a list of options, such as an S&P 500 index fund. With an IRA, you have a much greater range of investments, which is a significant benefit to these accounts. You can choose any company or fund, but it's difficult to go wrong with a low-cost S&P 500 fund because it delivers rapid diversification paired with growth and stability. For individuals with a higher risk tolerance, a more aggressive growth fund, such as an S&P 500 growth fund, is a preferable option, providing a balance of risk and potential return. Investing in an aggressive growth fund, such as Vanguard's VUG, means that more of your money will be invested in fast-growing companies like Amazon, Apple, and Home Depot. A fund like this will be more volatile, which means that it will provide higher returns when the overall market trends upward, but the returns will be lower when the overall market trend is downward for an extended length of time. An aggressive growth fund will, in principle, generate superior returns, which is ideal for investors with a long time horizon. A 2% variation in your annual rate of return will make a significant difference in the long run. However, you must be prepared over time to withstand the volatility and grasp the risk-reward trade-off. Individual stocks are popular among investors because they provide enormous potential. It is possible for a single stock to double or triple in a relatively short period of time, yet the same happening with a fund holding hundreds of different equities is exceedingly unlikely. Stick to large, stable blue-chip companies. These are stocks like Walmart, Apple, Procter & Gamble, and Coca-Cola. They've been around for a long time, and the chances of them going bankrupt overnight are quite tiny. Invest in firms where you properly understand the business strategy, which means you know how they compare up to their competition and how they earn money, rather than throwing money away that you'll never get back. Learn where to put your money as quickly as possible. A few little movements now could turn you into a very wealthy individual. Don't allow this opportunity to pass you by when you reach retirement age. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?